Hi, I'm Jared Nelson from the Investing Channel, and welcome to The Juice. The last time inflation was this bad, John Cougar Mellencamp topped the charts with Jack and Diane. And there's no silver lining in the Consumer Price Index, or CPI. Let's get straight into it with the bad news. Energy continued its steep ascent with a year-over-year increase of 33.3%. And food inflation jumped from 5.3% year-over-year last month to 6.1% this month. Shelter popped from 3.5% year-over-year last month to 3.8% this month, while only two categories, hospital services and motor vehicle insurance, saw month-over-month declines of 0.3% and 0.8% respectively. And as for the good news, well, there is none. Yes, the data really was that bad. Even airline fares, which had been on the decline the prior 2 months, jumped 4.7% month-over-month, although they're down 3.7% year-over-year. In fact, that was the only category down year-over-year this time around. Wages. When you hear about real wages, they're talking about wage growth minus inflation. So, if your paycheck increases by 5%, but inflation jumps by 6%, you're in the hole by 1%. And that was the case again this month as average hourly earnings declined 1.9% year-over-year. The bottom line is this. This data bolsters the case for the Fed to taper their asset purchases and raise rates faster. Markets began to price in a 33% probability of one rate hike in March of next year, with 43% expecting one rate hike in May and almost 12% expecting two. That should limit any upside potential and create more downside risk for equities and treasury bonds. If you're looking for a hedge, the TBT ETF tracks the inverse of the 20-plus year U.S. Treasury bond market prices. So, if U.S. Treasury prices fall, the TBT will rise. Otherwise, consider locking in profits on any winners you've had this past year. That's all we have time for today on The Juice. Click, follow, and subscribe to The Juice email for your daily dose of market minerals.